Welcome to UXL, where you can learn new skills anytime and anywhere. Visit uxl.com to explore our full course selection. This lesson is part of a larger course. Check the video description below for a link to the full course where you can enroll. If you enjoy our content, please like and subscribe. For your convenience, the course cover displayed on your screen provides the complete course title and lesson title. Let's proceed with the lesson. Lesson: Portfolio Risk Management. Portfolio risk management is a crucial aspect of financial management and investment strategy. It involves identifying, assessing, and mitigating risks associated with a portfolio of assets to achieve an optimal balance between risk and return. Understanding the principles and methodologies of portfolio risk management is vital for professionals aiming to excel in risk management roles, such as those aspiring to become an associate professional risk manager. The foundation of portfolio risk management lies in the risk and return theory, which posits that the risk associated with an investment is directly proportional to its expected return. This relationship is a fundamental concept in modern portfolio theory developed by Harry Markowitz in the 1950s. According to MPT, investors can construct an efficient frontier of optimal portfolios that offer the maximum expected return for a given level of risk. The efficient frontier is a graphical representation of the trade-off between risk and return, where each point on the frontier represents a portfolio that is considered efficient, meaning that no other portfolio offers a higher expected return for the same level of risk. One of the key components of portfolio risk management is the measurement of risk. There are various metrics used to quantify risk, with standard deviation being one of the most common. Standard deviation measures the dispersion of returns around the mean, providing an indication of the volatility of an investment. A higher standard deviation indicates greater volatility and, consequently, higher risk. Another important risk metric is the beta coefficient, which measures the sensitivity of a portfolio's returns to market movements. A beta greater than 1 indicates that the portfolio is more volatile than the market, while a beta less than 1 suggests lower volatility. Diversification is a fundamental strategy in portfolio risk management. By investing in a diverse range of assets, investors can reduce unsystematic risk, which is the risk specific to individual securities. Diversification works on the principle that the performance of different assets is not perfectly correlated, meaning that the poor performance of one asset can be offset by the superior performance of another. The goal is to build a portfolio where the overall risk is lower than the sum of the individual risks. This concept is encapsulated in the saying, "Don't put all your eggs in one basket." Systematic risk, or market risk, is the risk inherent to the entire market or market segment and cannot be eliminated through diversification. Examples of systematic risk include economic recessions, political instability, and changes in interest rates. To manage systematic risk, investors often use hedging strategies, such as purchasing put options or short selling. These strategies can provide protection against adverse market movements, although they may also limit potential returns. Another critical aspect of portfolio risk management is asset allocation, which involves distributing investments across various asset classes, such as stocks, bonds, and real estate. Asset allocation decisions are driven by the investor's risk tolerance, investment horizon, and financial goals. Strategic asset allocation is a long-term approach where the asset mix is determined based on the investor's objectives and periodically rebalanced to maintain the desired allocation. Tactical asset allocation, on the other hand, involves short-term adjustments to the asset mix based on market conditions and economic forecasts. Risk-adjusted return metrics are essential tools for evaluating the performance of a portfolio. The Sharpe ratio, for instance, measures the excess return per unit of risk and is calculated by subtracting the risk-free rate from the portfolio's return and dividing by the standard deviation of the portfolio's returns. A higher Sharpe ratio indicates a more attractive risk-adjusted return. Similarly, the Trainer ratio measures the excess return per unit of systematic risk, using the portfolio's beta as the risk measure. These metrics help investors assess whether they are being adequately compensated for the risk they are taking. Stress testing and scenario analysis are important techniques in portfolio risk management. Stress testing involves evaluating the impact of extreme market conditions on a portfolio, while scenario analysis assesses the effects of hypothetical scenarios, such as economic downturns or geopolitical events. These techniques help investors identify vulnerabilities in their portfolios and develop strategies to mitigate potential losses. For example, during the 2008 financial crisis, stress testing revealed significant risks in the portfolios of many financial institutions, leading to widespread losses and prompting regulatory changes to enhance risk management practices. Value at risk is another widely used risk management tool that estimates the potential loss in the value of a portfolio over a specified time period and at a given confidence level. VAR provides a quantitative measure of market risk and is used by financial institutions to determine capital reserves and manage exposure to market fluctuations. However, VAR has its limitations, as it does not account for extreme events beyond the confidence level and may underestimate the risk during periods of market turbulence. Credit risk is also a significant consideration in portfolio risk management, particularly for portfolios that include bonds and other fixed-income securities. Credit risk refers to the possibility that a borrower will default on their obligations, leading to financial loss for the lender. To manage credit risk, investors can conduct thorough credit assessments, diversify their holdings, and use credit derivatives, such as credit default swaps, to hedge against potential defaults. The 2008 financial crisis highlighted the importance of credit risk management, as the widespread default on subprime mortgages led to substantial losses for many investors. Liquidity risk is the risk that an investor may not be able to buy or sell an asset quickly enough to prevent or minimize a loss. This risk is particularly relevant for assets that are not frequently traded, such as real estate or private equity. To manage liquidity risk, investors can maintain a portion of their portfolio in highly liquid assets, such as cash or treasury securities, and avoid overconcentration in illiquid investments. During the 2008 financial crisis, many investors faced severe liquidity constraints, underscoring the importance of maintaining adequate liquidity in a portfolio. In conclusion, portfolio risk management is a multifaceted discipline that involves identifying, measuring, and mitigating various types of risks to achieve an optimal balance between risk and return. By employing strategies such as diversification, asset allocation, hedging, and the use of risk-adjusted return metrics, investors can enhance the resilience and performance of their portfolios. Stress testing, scenario analysis, and tools like VAR further aid in understanding and managing potential risks. As financial markets continue to evolve, staying abreast of best practices in portfolio risk management is essential for professionals in the field, particularly those pursuing designations such as the Associate Professional Risk Manager. This concludes the lesson. We trust you found this video informative and engaging. To enroll in the complete course, please use the link provided in the description below. At UExcel, we are committed to your learning journey. Each course offers a certificate of completion, online support, and downloadable resource files to enhance your experience. If you found our content valuable, we invite you to like this video and subscribe to our channel. Thank you for joining us, and we look forward to supporting your continued pursuit of knowledge.